Good day, this is Shauna Casey, and welcome to this SOS educational webcast, Death and Divorce. Don't let these taxing events take their toll on you. Due to the large number of attendees, no conference call service is available for this webcast. The sound will broadcast through your computer speakers. However, if you wish to ask a question at any time during the presentation, please feel free to type it into the questions and answers panel of your GoToWebcast console, and we will do our best to answer them as they come in. Any questions that we don't get a chance to address during the webcast, we will follow up with afterwards via email. This morning we sent an email with a link to the presentation materials to everyone that registered as of 10 a.m. Pacific this morning. You can also find the link to the materials under the Event Resources tab on your GoToWebcast console. This session will also be recorded, and we will send a link to the recording and materials in the next day or two. I hope that all of you are familiar with Stock and Option Solutions, or SOS as we are more commonly known. For those of you who are not, SOS is a leading stock administration, staffing, consulting, and outsourcing firm within the equity compensation marketplace. SOS provides interim and permanent placement, expert project resources, and total outsourcing solutions. To learn more, you can visit us online at www.sos-team.com or call us at 408-979-8700. Next, I'd like to introduce you to our speakers for today's session. We are pleased to have Sarah Roberts and Sorrell Johnson on the panel today. Sarah has been a senior equity consultant in SOS's People Solutions Group for over 5 years. She has worked as an equity plan consultant for over 15 years and also has more than 15 years of experience in finance and accounting. Sarah is an instructor for the Certified Equity Professional Level 1 courses offered by the National Center for Employee Ownership, and has made equity presentations for a variety of organizations. Sarah received her CEP designation in 2007 and is a graduate of Mills College, and also holds an MBA with an emphasis in finance and accounting from the Anderson School at UCLA. Sorrell began working in equity compensation in 1997 and has held equity management positions at NetApp, Redback Networks, and Ariba, an SAP company. She currently works for Stock and Option Solutions as a senior equity compensation consultant. Sorrell speaks at various events, including industry webinars, the NAS National Conference, GEO, and NAS University. Her areas of expertise include employee stock purchase plans, spin transactions, mergers and acquisitions, and she also has experience in global equity compliance in over 50 countries. Sorrell received her Certified Equity Professional designation in 2003, and she is a member of the Professional Services Group here at SOS. Next is our standard disclaimer slide. We'd like to remind you to consult your own advisors before making any changes. As I mentioned, the materials are available on our website, and here again is the link. Thank you all for joining us today, and with that, I'll turn this presentation over to Sarah, who will introduce our topic and cover the agenda. Thank you.
Well, death and divorce are topics that don't come up very often for most of us. I suppose if you worked in a big company or one with a aging population, you might run into it more often. But for most of us, it doesn't come up very often, and so it's kind of hard to remember all the things that you need to know, and especially about taxation. That's why we decided we were going to talk about this today. So the first thing we're going to do, I'm going to talk about death. I'm going to focus on the taxation of equity awards and year-end reporting. We'll touch briefly on financial reporting issues, and then Sorrell is going to talk about divorce, and there's lots of administrative issues around divorce which are fun to deal with, and she'll also focus on taxation of equity awards, year-end reporting, and briefly touch on financial reporting issues. Oops, there we go. Okay, so death, not a happy topic, not one that we like to think about a lot. But you find out that one of your employees has died, and what do you need to do? First of all, you need to know what your plan or plans, depending on your situation, what they say about the death of an employee. If you don't know, you need to go back and look it up. Some plans vest upon death. How much? Maybe 100%. Do you accelerate options? Do you accelerate options and RSUs? That's what you're going to find out in the plan. And then another thing that you need to think about, if you have a company that deals with beneficiaries, there are companies out there that allow for their employees to have beneficiaries named. Whether you should do that or not is really up to you. One of the things that you have to think about when you're talking about beneficiary forms is, what are you going to do? How are you going to manage them? And I've only been in a couple of companies where they've had beneficiaries and they've just stuck them in a file. And hopefully there's better ways to deal with it than that. But at any rate, if you're the company that has them stuck in a file and somebody has died, you need to go and find out if they were one of those people who had beneficiaries. Another thing that comes up is that you need to make sure that the descendants or the survivors are connected with the broker or the plan provider. And while we as stock administrators don't always have a lot of deaths and divorces coming along, deaths we're talking about in my case here, while we don't have a lot of them coming up, the brokers have it happening all the time, and they even have departments that can deal with all of this stuff. So as the stock administrator, you're going to need to make sure that the survivor of the employee is connected with the broker and that they can get the amount of information that they need in order to set up an account so that they can exercise the stock that's left over, the awards that are left over. So we'll move on to tax, and we'll start with ISOs. And we have this question: ISOs can't be transferred, can they? And of course, the answer to that, if you know your Section 422 of the Internal Revenue Code, is yeah, they can be. And the only time they can be transferred and retain their status as an ISO is when an employee has died. That's specifically spelled out in Section 422. So yeah, you can transfer the ISOs, that's fine. Our next question says, if the option E exercises an ISO before death, what's the tax treatment for the estate at sale? Is this a disqualifying disposition? And Section 421 of the Internal Revenue Code, which kind of deals with some of the general provisions of 422 and 423 plans. It says specifically that in the case of a death, the holding period isn't going to apply. The tax-qualified benefits of the ISA remain, but the holding period doesn't apply. And furthermore, it waives the employee requirement, so that makes it possible for you don't have to be an employee in order to exercise. And that's how the survivors are going to be able to exercise the option. So always, the answer to the disqualifying disposition question is that it will always be a qualifying disposition because the holding period goes away. And so you don't have to worry about whether you're 2 years from the date of grant and 1 year from the date of exercise. That doesn't have to happen. So ISOs are pretty clearly spelled out what happens. Unfortunately, non-qualified options, it's not as clear what happens in the case of death. We did a lot of research on this before the presentation and found there was a lot of conflicting information for non-qualified options. What's on this slide, the information on this slide is what everybody seemed to agree on. So we'll go over those things, and then we'll talk about why things can be a little bit, why there was so much conflicting information. So for non-qualified options, if it's still in the employee's name and you exercise it in the year of death, the income is going to be included on the final W-2, and as the employer, we're required to withhold federal income tax and FICA and FUTA. And somebody will probably ask, does this include state tax? And yeah, you'd usually include state tax with that as well. If it's bequeathed specifically to a beneficiary, so we're back talking about companies that have that allow employees to have beneficiaries. In that case, the beneficiary is going to recognize ordinary income at exercise. So the company is going to end up filing a 1099 miscellaneous in the name of the beneficiary. In the case of a non-qualified exercise, and I think we're talking here about an estate doing the exercise, federal income tax withholding isn't required. If the exercise occurs in the year of the employee's death, though, you're going to have to collect FICA. We'll talk more about FICA in a few minutes. Income for the estate is reported on Form 1099 miscellaneous. If FICA is withheld, you're going to report it on the employee's W-2. And once the non-qualified option becomes part of an estate, or if it's exercised the year after the employee's death, there won't be any withholding. So generally, the reason we had conflicting information, I think, is because people are looking at who are you going to tax? Who's going to be taxed? Is it going to be the employee, or is it going to be the employee's estate? Technically, the estate occurs as soon as the employee dies. Their assets are their estate once they've died. But things can be kind of complicated when people die. It's not always a clean process. We don't always know what's going on in a family. If it's a sudden death, it may take people a while to get their act together and get things organized. If it's a community property estate, it may be passing to the spouse. What else could happen? Just a lot of things can happen when you're dealing with a death. And
Sarah, can I jump in here?
You can jump in.
So the other thing that, kind of causes a delay, and when Sarah and I were going through this presentation, we were talking about this. Some people, I'm sure that there are some of you out there who have wills and they're drafted, and you have a copy with your lawyer and you have a copy in your safe deposit box, and maybe your executor has a copy. But I'll be honest with you, I've picked out a lawyer. I haven't had time to go have a will drafted. If I die tomorrow, basically everything has to go into probate. And when you bring a court into it, the courts could take forever. In some cases, you might be calling the widow or widower or child or whomever is a beneficiary a year on and saying, guys, we really need to get this exercise done. Because even at that point, you may be scrambling at the last minute, and that's just in the U.S. International deaths are even worse, if you can imagine. I had one time in Asia, and the gentleman had been in an accident, and it was a long story, but he had actually been on a ferry that had gone down, and it was presumed that he had perished. And the court in that particular Asian country said, well, if we don't have a body, we can't issue a death certificate. And so here's this poor widow trying to get some sort of certificate so that she can turn around and give it to the broker, because of course the American broker has to have something. And they're like, well, and I said, can we take the news article? I mean, seriously, can we help this lady out here? It did turn out that they did finally issue one, but these things can drag on. So it's not. Don't think that just because, oh, by the way, I've been notified that the employee died. I'm going to go ahead and take care of all of this, and I'm going to wrap this up in like a week or 2 weeks. This really, realistically, could be a month-long or even year-long process.
Absolutely.
Yeah.
So that's kind of why we have this conflict in information. It's people trying to decide whether it's going to be in the employee's name or in the name of the employee's estate. And you do different things based on that. That kind of drives everything else. So some of the things that we can remember, I think it's valuable, it helps me, I know, is that the spread is going to be taxable. So, I mean, you exercise options, it's going to be taxable. The IRS never goes away. It always wants its money, and so somebody's going to have to pay taxes. It's going to be the employee, or it's going to be the employee's estate, or in some cases it might be a beneficiary. But that's about your choices, and once you make those choices, then that kind of drives what you do. That kind of helps. One other thing that I think helps is the rules about FICA withholding. It's Section 3121 of the Internal Revenue Code. There are provisions. There's a place where they talk about wages that are taxable for the purposes of FICA taxation. And in those rules, it excludes specifically payments that occur because of death. So if you have accelerations, those are payments that occur because somebody died. They weren't going to happen unless the person died. So those would not be taxable for FICA purposes. And the other thing that they exclude from FICA taxation are payments that occur after the year of death. So if if somebody exercises the year after the employee dies, then there won't be any FICA taxes that are due on that. So that helps, because I'm always sitting there going, well, when do I pay FICA and when do I not?
So we've got a couple of questions.
A couple of questions, okay.
The first question is, what is a good resource listing which are community property states? Because, oh dear, this person their company has employees in all 50 states plus Puerto Rico.
Oh, boy.
Wow.
I don't know. I mean, off the top of my head, that's a legal question. I would get on the Internet and look for it, is what I would say.
You probably could get on the Internet and look for it. You might want to talk to your legal department. This is something, community property states, it's not like this is something that changes all the time. This might be if you had to go out to like a lawyer and pay to get, the official list. I would see that as a one-time expenditure that the legal department might go ahead and authorize if they don't know. Because clearly if you're at a company and you're with a bunch of corporate lawyers, they are not going to have any clue about that. I actually talked with a corporate lawyer about this subject. We gave a presentation, and he said, I'll be honest, I don't know the laws of wills and dissent in Wyoming. He's like, that's not my specialty.
Yeah.
Or in like Botswana. He's like, I don't have a clue internationally. But again, that's not his thing. It's not his specialty. So you might need to go outside your company for that. But again, I'm thinking that's going to be like a one-time expenditure. If you can't find it on the Internet, you might be able to do that and save a little money. Next question says, if your will identifies who should receive outstanding equity upon death, will the equity awards avoid probate?
Again, legal question. I don't know the answer to that. Do you?
I do not. I'm guessing that the answer is yes. However, in some states, and again, we're talking about 50 different sets of laws, I know that even if you have a will, some courts basically, you have to go in and say, this is the will, and the court goes, oh, okay, great, we don't think there's any fraud here. Stamped, been through probate, good to go, you're out of here. I know some states do that, some don't. Like if you can present a valid will, there you go. That is going to be one of those things that you're going to need to check in with the brokerage firm, because in some ways you have to take your direction from what they say. If they're satisfied with the documents and they say, okay, we're satisfied that the beneficiary of Joe's stock options is Mary, and we're opening an account in Mary's name, and we will go ahead and accept an exercise instruction from Mary, then it's our job to process it. You know, the validity of that isn't our concern, and that's where it's kind of nice because that's the broker's problem.
Really?
And then there's another question that says, with all the references to year, are you talking about the calendar year of death or 12 months from the date of death?
I'm talking about the calendar year. These are tax years, which generally, I mean, these would be personal income tax years, right?
Right.
So generally January 1 to December 31st. And that's another thing, it's the timing of the death. You know, I mean, you might have time to deal with all this stuff if somebody dies in January, but, you know, to work through things. But if they die on the 29th of December, and you've got to do something on the 29th, you know, on the 30th, then you're in trouble. So the other point I wanted to make about on this page and about the non-quals, because it's kind of confusing, because there's conflicting information, you know, if you can't work it out, if you can't figure it out yourself, and if you can't, we sympathize and we understand. Then you may just need to talk to your tax advisor and, you know, your internal tax department, if you're lucky enough to have one that will talk to you about stock. Otherwise, your external tax advisor. Because what's going to happen is if you get audited, you know, and a question comes up about the way you've handled something, you want to have, you know, somebody who's going to back you up on this and who has an opinion, or at least who agrees with the stance that you're taking. So that's my final point on non-qualified options and death. We move on to ESPP, and ESPP is a happy thing because that falls under Section 421 that we already talked about of the Internal Revenue Code. Specifically does away with the holding period in the event of death, and does away with the requirement that you have to be an employee. So the disposition is always going to be a qualifying disposition with an ESPP as well, just like an ISO always has a qualifying disposition. Moving on to restricted stock. If there's no 83B election in place and the stock vests upon the employee's death, the income is going to be included in the year of the employee's death, and you're required to withhold the federal income tax and FICA in that case. If the shares are released to a beneficiary or an estate, the company is not required to withhold federal income tax. Restricted stock, especially when you have accelerations, that a lot of times if there's an acceleration of restricted stock and you have to do a release immediately, that's one of those cases where it's really hard to know, you know, exactly what to do. I mean, you're not going to have, you may not have an estate to assign the income to. And I think Sorrell said that she had run into a lot of situations where she's had to do restricted stock accelerations right at the time the person dies because there needs to be income for the family. That's the whole idea of these accelerations, is that, you know, somebody's died, it may have been unexpected or may cause a financial hardship, and so That has to happen immediately. And so there's some similarity to non-quals in that you just don't know exactly where the estate versus employee situation. There probably isn't going to be an estate if you're releasing right at that time. Option and award accelerations. No FICA and FUTA due on this portion. Just as we said before, the FICA rules are pretty clear. If the income comes because of a person died, then you don't have to pay FICA taxes on it. That's not FICA income. Income for FICA purposes. Year-end reporting. So we've gone through this already also, but transactions which occur in the year of death, that's going to go on the W-2. There'll be tax withholding reported on it as well. For transactions after the year of death, that'll be reported on a 1099 miscellaneous, and it'll be made out in the name of the estate. Let's see. We have a question, Sorrel. Let's see. What does this say?
Says, for ESPP, is it correct that you don't need to file a Form 3922 for a deceased participant until there is a transfer?
I don't know.
So I don't.
You know what I do? I have to say this. When I need to do for 3922s, I go to SOS and have our wonderful department go out and do it for the company I'm working for. Now you can you can answer the question.
I'm going to take this question away. I would say that pretty much the IRS under 6039. If you have given the shares out, you have to file a Form 3922. And of course, at the time that the shares were basically purchased under the ESPP, the person would have had to be, first of all, alive, and secondly, an employee. So my gut feeling here is that you have to send it to the employee's address at the end of the tax year, just like the IRS is going to send them, say, a Form 1040, even though they're not still alive. They're going to say, hey, we feel we're owed one last tax return. But let me go back to our 6039 group and ask them this question, because this is fascinating. I've not thought about this, but my gut instinct is that, yes, you've got to issue the deceased employee a Form 3922. I'll confirm and get back to you on that one. Okay, it looks like another one's come in here. If the estate TIN, so taxpayer ID number, is unknown and a decedent has RSUs automatically vest upon death, is the 1099 miscellaneous issued using the employee's Social Security number, or do you leave it blank? I don't know that you can leave like a 1099 miscellaneous blank. I think you have to have. Am I right on this, Sarah? There's got to be some number.
I was going to say you can't issue it without a number.
Well, I
know you've done this.
So what we always did was, and kind of a little background for the folks on the phone. Sarah and I talked about this, and she referred to it in passing. I used to work for a CEO who we only granted restricted stock units, and he was very employee-friendly. And, I mean, the minute he heard about an employee death, he got to me usually before HR did and said, look, he had the power under our plan to accelerate under a certain number of shares. And he basically, between he and I, on the day that we found out about it, we would accelerate and I would process and release any unvested RSUs for the employee. And we sent them over to the broker. We taxed them just as though the employee was still alive. So federal, FICA, FUTA, state, all of that, and we sent those shares over. And it was his philosophy that basically the employee earned it. They gave up, basically they perished while working for him. They had earned this kind of bonus that their family would need in a going forward capacity. And so we always included it on the employee's final W-2 that we issued. Now, and Sarah's kind of also talked about this. I think that in the IRS's eyes, as long as they get their money and the income gets reported, yes, we're giving you some rules that are hard and fast, but I think there's a lot of leeway with the IRS, especially in cases of death. I once had a widow ask me, I know you don't have to withhold state, but could you please? And I said yes. I mean, what's the harm in over-withholding, because it's going to get flushed back to her. And I think it's more important that the reporting, the IRS knows about the income and some taxes were collected than, oh my God, did we do this exactly by the rules and regs? I think they cut you some slack when you try. I mean, am I right, Sarah? How do you feel?
Well, that's how I feel. I mean, this isn't advice. We're not giving tax advice that it doesn't matter. But we're stepping back, and we've given you the rules that we know. We're stepping back and going, somebody has to get paid. The IRS has to get paid, and they will. This is the problem. There are issues, lots of issues in stock administration, which really aren't very clear, and where you have to kind of decide what's going to, what's the most important thing. And I think it would be my gut feeling that getting paid would be the most important thing for the IRS, and getting paid where they understand where it's coming from. Kind of touching back on this question about the tax ID number. And if it was me and I didn't know, I'd probably err on the side of withholding too in cases like this. But
agreed.
That's me, and that's not tax advice. So we do agree.
Yep.
Alrighty. And so to finish out this happy topic, just briefly, things that you need to think about for compensation expense. If anything's going to impact your financials, it's going to be vest acceleration. And I really don't know all of the ins and outs of that. And that's something I would talk to the accounting department about. We've also got transfer of options here, and that one I really don't understand how that would impact the financials. You and I talked about that, Sorrel. Go ahead.
Yeah, it shouldn't. I mean, if you're just transferring the options into a different name, it shouldn't impact the financials. Mm-hmm. But again, you'd want to talk to the accounting department and let them know, and be prepared, because the auditors, when they go back, we all know that the minute that you have one thing that is different, not necessarily wrong, but just different,
exactly.
The auditors are going to jump all over that, and what is this, and why is this done, and where was the authority to do this? So just make sure that you're prepared, because it's quarter end. You've had to do all of this anyway, and now the auditors are back and they're jumping all over you. Some are nice, some are not so nice, and it's one less thing. And if you're a little bit prepared and you just say, oh yeah, that was John and he died, and we had to transfer the option to Mary, it makes your life a little bit easier.
And I guess we're talking about, transferring from one name to another name, and from an employee to a non-employee, that kind of thing. But I don't think it's going to make a difference. Alrighty, so I think at this point we can turn this one. That was fun. That was happy.
I know, so if you were the angel of death with With your part, what am I? Am I the queen of divorce?
I mean,
queen of divorce. What is that?
I don't know.
Okay. So this is a little bit happier topic, guys. I mean, at least you're still alive at this point, and your employees are still alive. Nobody's passed away, but there's going to be a whole lot of contentiousness, maybe even some hatred going on. So let's talk about divorce. So it all kind of starts with plan design, and the basic question is, are your options and awards transferable? If you're fortunate enough to be involved in plan design process, or maybe you're amending your plan and you are going back to the shareholders and everything, and maybe you can drop in there, hey, we're not going to be, we're not going to transfer options in cases of divorce. My advice is just say no to divorces. It's much easier. I have actually administered plans where the options and awards were non-transferable. I have had to explain this to employees and judges who, of course, their thing is family law, divorce law. Their thing is not corporate law and not stock plan administration. And one judge said to me, so you're telling me that the legal document that the employee signed said that this option can't be transferred, it is only good in their name? And I said, yes. And he said, okay, they can find another asset to split. And that has been my quote for years, because I thought that just brought clarity to the moment. Find another asset to split. Now, when you're talking about your brokerage requirements, are you going to require the non-employee former spouse? So John and Mary are married. John's your employee. He divorces Mary. Are you going to make Mary use the captive broker? My advice is yes. It's the easiest to track the activity and deliver the shares this way. And, if you're going to require Mary if you're going to split an award and require Mary to accept that award, then really Mary needs to be with your captive broker. And occasionally you'll have a non-employee former spouse that they want to have absolutely nothing to do with anything that is remotely connected to your employee. And they may balk at you saying, well, we need you to use this broker. And, my comment to them is, look, I know you don't want to use the broker. Maybe you have a pre-existing relationship with another broker, but we need to track these transactions. And once you get your money, you're free to take that money anywhere. Every U.S. brokerage house offers ACH, and you can basically transfer it for free. We just need to make sure when it shares that we know where they are. And lots of times, if you kind of talk them off the ledge, they'll grudgingly be like, well, okay. Besides, they want their money. And if you tell them this is the only way to go, then this is the only way to go. Now, the other thing that you need to kind of be on the lookout for from the non-employee former spouse is, first of all, you've got to have their contact information. Name, that's a given, address, social security number, preferably a phone number where you can get a hold of them, home or cell phone, in case you need to reach them. Now, they may ask you, and this is kind of like a two-way street, they may want information on transactions that are in your employee's name. And they may be entitled to this information. They may not be. They may just be darned nosy and wanting to know. And we'll talk about why they might need to know that on our next slide. So the treatment of awards, basically there's going to be three ways that these are going to be handled. The first is, are these awards just retained by the employee? That's number one. Number two, are they going to be transferred to the non-employee former spouse? And then number three is, are proceeds resulting from option and award sales transferred to the non-employee former spouse. Now, 1 and 3 are the easiest. 2 is a huge, huge headache. And let's talk about why. When you need to split these up, first of all, let's go back and revisit. I know you're saying, whoa, ISOs can't be transferred except in case of death, which Sarah talked about earlier. So I've got an employee who's got ISOs, so these can't be split up, right? Well, sort of. We're getting a lot of sort of answers today. In 2005, there was a tax court revenue ruling, and that's Revenue Ruling 2002-22. And it basically is regarding the split of an ISO in a divorce case. And what it says is that in a divorce case, the employee and the non-employee former spouse can agree to the split of the ISO in writing. Now, the employee is going to retain legal title to this ISO. And the exercises will only be processed at the written instruction of the non-employee former spouse. And the resulting shares then get transferred immediately to the non-employee former spouse. And they take on all applicable tax liability. So basically, the non-employee former spouse is stepping into the employee's shoes. Now, again, so they may come back and say, hey, Mary may say, I instructed John to exercise, and I need the information on that. Well, yeah, legally she's entitled to it. But, if she comes back and she starts asking about things that, weren't transferred to her, that's something, keep in mind, some divorces are friendly, and some people are great, and then you're always going to have that 1% that are really nasty, and maybe they're a little bit on the dishonest side. So keep in mind, too, when you're processing divorce, and this is something that it wasn't really mentioned on the slide, there's some data that's private and isn't going to be shared between the two, so just remember that. Now, we talked briefly about the underlying options and awards retained by the employee. That's great. Life goes on. Nothing happens. It's their asset. We pretend like we don't even know that John divorced Mary, and we go on with our lives. It's great. Option 3, when we talked about, proceeds resulting from the options and award sales, again, that's a lot of, that goes on behind the scenes. That's not our business. We go ahead and we distribute shares to the employee, and life is all rosy. Now, in that case, too, by the way, when the proceeds are just transferred to the non-employee former spouse, they don't have any tax consequences. The employee is going to be taxed at regular rates on the transaction. Now, we did talk about transferring, and we talked about the ISO in depth there. For non-quals, RSUs, RSAs, they can be issued in the non-employee former spouse's name. The IRS doesn't care, that's fine. And in that case, they're just going to be taxed as regular employees. At exercise or vest, all employee taxes are going to be withheld. Now, this gets interesting because you now have somebody who, in effect, you need to create a W-2 for. But they're not an employee, so they're not getting paid, which means you've got to go talk to payroll. When a divorce happens, pretty much you're going to have to bring payroll and HR into this. And the reason that you're going to also need to bring HR into that, they may already be involved. They may have brought this to you in the first place. Some payroll systems are set up so that they receive a direct feed from your HRIS system. And it says, hey, here are all of the employees. Well, some companies say, we're not going to put a non-employee former spouse in our HRIS system. So therefore, when their name doesn't come over to payroll, the payroll system says, oh, name's not there, terminated. and they basically shut them down in the payroll system. So this is going to be probably kind of a manual workaround if you have a bunch of file feeds set up that go between stock and payroll or HRIS and stock. This is going to be one of those kind of exceptions or error outs that you're going to get a lot. And you need to be aware of that. Now, slides talk briefly about the transfer of shares for ESPP. Once they're purchased, if they have to be transferred to the non-employee former spouse as part of a divorce decree, this is not a disposition. Now, the non-employee former spouse is still subject to tracking, and they have to follow all of the ESPP qualified and disqualifying disposition rules. So again, this is why we like to keep them at the captive broker. We can keep an eye on these shares. And I think we are good for this slide. Do we have any questions? Looks like we might have another one.
Did you see this one? This is, it says, this might be a silly question, but by refusing to split, there are no silly questions, but by refusing to split the awards and forcing the court to find another asset to split, can that put the employee in a bad situation? For example, being forced to split a non-liquid asset and therefore having to sell a house or valuables instead of the stock award.
That is a distinct possibility. That may happen to the employee. That's not a happy outcome for them, clearly, but it is possible that the kind of find another asset to split theory does negatively impact the employee.
Okay, that's the other question we had has gone away. So,
okay.
Shall we move to the next slide?
All right, then I'm going to move on to my next slide then, since we're running a little long today. I guess you and I are very wordy. So the stock-based comp expense. Again, transferring, most systems have the ability to do a transfer. It shouldn't impact your expense if you're just simply transferring the award. If you're splitting them, this is where life becomes really fun. Because you're going to need to make sure that you've got all of the details of the original award, including all the expense. I would suggest running a quarter, year-to-date, and all-time expense report for these awards, these specific awards, prior to the split so that you can run it after and tie back. Now, be aware when you split these, there's kind of a unique thing that may happen to you. You may have to be creative with your dates. Normally what you would do, when I say creative with your dates, normally what you should do in your system is when you receive the divorce decree, and it says this divorce was final on July 1st, then you can go in and you can cancel the awards using your July 1st date. Now, what happens if you don't get notified about this until, say, November? And you go, oh, okay, well, let me go in and cancel that. And you look back, and the employee exercised in August. You can't cancel the award if there was a subsequent exercise or, say, a subsequent release. Now, this is one of the, shall we say, less fun things to deal with. You may also, the broker may also come back to you and say, hey, we've opened the account now and we're splitting these vested RSUs or this exercise that happened on August 1st. Can we get some cost basis? But with the expense, you're going to need all of your pre-split information, and you're going to have to make it tie to post-split. Now, most of the time you can get these to tie back within a few pennies. because you have to massage all of this, you may be off by a few pennies. And again, when we're talking about the auditors, if they routinely go through and look at award numbers and suddenly your award numbers, one disappeared and they can't tie it to, say, a termination on their termination report, they're going to be back, they're going to be in your face, they're going to want to know why. By this time you will probably have a boatload of documentation on this in a binder somewhere that you can give to them and go, here, take this, go take a look at it. But again, we need to make sure that our stock-based comp isn't negatively impacted by having to split awards. And this sole reason is why I am very pro find another asset to split. Because when it comes to messing with stock-based comp, I am one of those that goes, no, we don't want to touch that. We don't want to have to do anything out of the ordinary. We don't want to mess around. So that's generally why I have my split another asset attitude. Now, that's kind of to wrap up. How about some resources? We've stressed your equity plan and your agreements and forms associated with that, your grant agreement. Sarah has talked about IRC 421 and 422. There's also some good information in IRC 3121A, subsections 13 and 14.
Yeah, I talked about that. That was what gave us the FICA award.
You're so close.
I'm thinking of credit scores.
Well, the divorce or death might impact your credit score. Anyway.
That's another topic for another day. But no, that was that really clearly tells you about the FICA and what you can exclude from taxation. So I like that code.
And we've also talked about talking to your outside counsel and your tax advisory firm or your accountant about these types of situations when they pop up. I'm going to give a big shout out to Barboxa for her yearly tax webcast. You can get it at nash.com. She does it every year in December. I have to strongly encourage everybody to watch it. She gives out some great information, and she actually has what I call pictures. She will show you the W-2 or the 1099, and she has her little red arrows that show, and this is the box where you should report it. I think that's great. I learned from pictures, so I was just like, wow. And I'm sure that she will probably be doing another one of these next month. So that one is a must-see. And then also some of the information that we presented today we pulled from these couple of books that are required reading for the CEP test. So if any of you on the webcast are studying for your CEP, you will probably be very intimately familiar with these books.
Yeah, Selected Issues has a section on handling death under a equity compensation plan. So, in particular.
Now, I think, do we have anything? We don't have any more questions because I was going to say our next slide is questions, but we've kind of been taking those as we go. So,
I'm not seeing anything, but we can wait.
If we don't have anything new, we will. The person who asked about the ESPP and the Form 3922, we will come back to you via email with that answer. So give us a day or two to get that figured out, and we'll get back to you on that. But I think we're wrapped up, and I think we can turn it back over to Shauna unless you have any last parting remarks, Sarah.
Oh, I don't. No, thank you.
All right.
Okay, thank you, Sorrel and Sarah, for speaking today, and thank all of you for attending today's educational webcast. Please do look for an email in the next few days with links to the recording and materials. Thank you again, and have a great day. Bye-bye.